STC has put together this presentation regarding T+2 settlement date, which changes September 5th, 2017. So many of STC's courses, Series 6, Series 7, Series 9, 10, 23, 24, 27, 52, 53, 99, even the Series 79 to some degree, as well as the 57 and the 14, all mention the settlement date, and this hasn't changed in quite some years. So it's effective September 5th, 2017, and regarding that date, anyone taking a licensing examination on that day forward can expect the new settlement date T+2. For many, many years, it's been 3 business days from the trade date, and now moving to a T+2. Now, this affects a number of different parts of the law, ex-dividend date, accrued interest, and things like that. And it also affects not just FINRA rules and SEC rules, it also affects the MSRB as well. So we're going to go through this presentation and discuss old versus new, and again, make sure that everyone's comfortable with the T+2. Securities Training Corporation is in the process of changing its study manuals, examination, licensing questions, flashcards, and on-demand lectures. They should be done somewhere the week of the 5th. Some products will be updated sooner than others. So let's go on and start with the presentation. Now, the term regular way settlement refers to when a transaction settles between 2 broker-dealers, between the buying broker-dealer and the selling broker-dealer. The settlement date is not a regulation that really applies to the customer transactions. It's between the 2 broker-dealers, the buying and selling broker-dealer. So based upon the new T+2 rule, corporate securities and municipal securities, which means common stock, preferred stock, corporate debt, as well as municipal securities, short-term, long-term municipal securities, will now settle 2 business days after the trade date, or T+2. Government securities settle next business day. Option trades also settle next business day. And instead of doing the transaction regular way, which is normal business, sort of like regular mail, you can have an execution, what's called a cash transaction. That is set up specially between the buying and selling broker-dealers, where they both understand that the securities will be delivered the same business day, and the securities will be paid for between the 2 broker-dealers the same business day. So it's sort of a different matter of settling a trade versus regular way transactions. So again, corporates and munis settle T+2, governments T+1, options T+1, and any transaction for cash will settle the same business day. When it comes to dividend dates, we're referring to primarily cash dividends. And when we discuss cash dividends, there's 4 dates of importance: declared, payment, record, and ex-date. Of those 4 dates, 3 are determined by the board of directors. Now, the 3 that are determined by the board of directors would be the declared date, the payment date, and the record date. The ex-dividend date is a function of the settlement date, which is now T+2, which used to be T+3. So again, 3 of the dates are determined by the board of directors, pretty much the same thing every quarter. The ex-dividend date is not. It's determined as a function of the settlement date. Another point I'd like to make is, if asked on any licensing examination, what is the order of events? Well, in other words, what happens first, second, third, and fourth? It would be the declared date would be first, the ex-date would be second, the record date would be third, and the payment date would be the 4th date. Payment date would be the date you receive the actual distribution, the check, or the stock, if it was a stock dividend. So the record date really refers to if the corporation opened up its ownership books, and anyone who's an owner of record on that record date would be entitled to the dividend. If you're not, you would not be entitled to the dividend. So question is, when is the ex-dividend date? Well, if the settlement date in a regular way transaction is T+2, that would mean the ex-dividend date would be 1 business day prior to the record date. 1 business day prior to the record date. Now, to really hone in on this, to make sure we have a firm understanding, let's do an example. We have here dividend dates. The record date determined by the board of directors is Wednesday, May 11th. So whoever is an owner of record on May 11th is entitled to the dividend, which is usually paid out a few weeks later. The general rule is the ex-dividend date, as we discussed previously, the ex-dividend date is 1 business day prior to the record date. Therefore, the ex-dividend date would be Tuesday, May 10th. Now, the reason I got the name ex-dividend date, the preface EX means without. So anyone buying it regular way on May 10th or afterwards would not be entitled to the dividend. Anyone buying it before, let's say the 9th, the 6th, the 5th, would be entitled to the quarterly dividend. Let us do an application using the chart below. If the trade date is Monday, May 9th, it would settle 2 business days later, which would be May 11th. Since your name would be an owner as of the close of business on the 11th, because you bought the stock prior to the ex-dividend date, the buyer would be entitled to the dividend. Corporations certainly not going to pay 2 dividends. They will only pay 1 to whoever is an owner of record. Next, buying the stock or transaction date is May 10th, which means it would settle May 12th, which is after the record date because you're buying it on the X date. The seller would be entitled to the dividend because the buyer would not, therefore the seller would. If the transaction date was May 11th on Wednesday, the settlement date would be the next business day, the 13th, and then it's even Friday the 13th. Therefore, the seller would also be entitled to the dividend. So if you buy the stock on or after the X date, you're not entitled to the dividend. And again, buying the security on May 11th, the transaction would settle Friday the 13th. However, on a cash trade, not a trade in a cash account, a cash trade, not regular way, done on May 11th, would settle on May 11th, the record date, and therefore the buyer would be entitled to the dividend. So it's important to remember, on a regular way transaction, anyone buying the stock before the X date would be entitled to the dividend. If buying the stock on or after the X date, you would not be entitled to the dividend. For the seller, it's the reverse. For the seller, if you sold the stock prior, on the 9th, let's say, you would not be entitled to the dividend. But if you sold the stock on the 10th, 11th, or any day on or after the 10th, you would be entitled to the dividend. And the outlier there is the cash trade on May 11th. We're going to do an example on accrued interest. And the reason why there is accrued interest is because corporations or municipalities or government or the U.S. government, when they make interest payment checks, it's every 6 months, they pay that to whoever's an owner of record. Well, if you sell the stock in between the coupon paying dates, you're not going to receive that interest check. Well, you did hold the security for a certain period of time. Therefore, when you buy a bond, you would receive the entire 6-month payment, but you're not entitled to the 6-month payment. Therefore, the buyer of any security that has interest payment, like a corporate, muni, or government, would pay the seller the dollar value of accrued interest. And now, how do you calculate accrued interest? So let's go through an example here. We have a corporate bond, and then actually we're going to do another example on a government so you can see the difference. And this same example we're about to do on the corporate bond would also work on a municipal security because municipals and corporates both settle in 3 business days as well as have a 30-360 calendar. Okay, so XYZ corporate bond, $1,000 par value, 8.5% coupon, which means $85 per year. Now, if the due date is May 15th, therefore that has to be one of the coupon paying dates, which means if one's May, the other one has to be November. And if the bond is sold, purchased by the investor, then sold to that investor on Monday, May 14th for regular way settlement. So we look at our calendar here, and the coupon paying dates are May 15th and November 15th. The settlement date would be September 16th. Why? Transactions in corporates and municipals settle in T+2, 2 business days from the trade date. It was 3 business days from the trade date, but it's now 2 business days from the trade date, which means it would settle Wednesday, September 16th. Accrued interest is calculated from the last payment date up to, but not including the settlement date. And the reason why you don't include the settlement date, because you're the buyer and you own the security as of the settlement date. So let's look at our example. Again, Reminder that corporates and munis are both settled in 3 business days and have a 3360 calendar. Some people ask us, why 3360? And that's called market convention. What that means is that it's simply the way it's been done for many years. The standard convention is munis and corporates both have a 3360 month. Now, you count the 15th, which is interesting, and some people don't remember that, but you count the 15th. So, May would have 16 days. Now remember, it's 3360, and if you count the 15th, that would mean 16 days in May, 30 days in June, 30 days in July. Remember, it's 3360, 30 days in August, up to but not including the settlement date. Well, if it settles on September 16th, you would have 15 days in September for a total of 121 days of accrued. So on the examination, you may be asked the number of days of accrued interest, but in this example is 121. If the bond had paid interest on May 1st and November 1st, then in May you would include 30 days, not 16 days. You include 16 days because it starts paying on the 15th of the month. Okay, let's calculate the dollar value of accrued. It's principal times rate times time. Well, the principal is $1,000. The rate is 8.5%, which is $85. And we multiply that, the percentage of the year, which is 121 days out of a calendar year of 360, which equals $28.57. So when you bought this bond, you'd pay the market price, whatever it is, plus $28.57 per $1,000 bond. Next, let's make believe it was a treasury note or treasury bond, which has 2 differences. Number 1, the settlement date on treasuries is next business day, and number 2, its actual number of days of the month and 365 days of the year, of course. So if we purchase a treasury security on Monday the 14th of September, it would settle on the 15th, the next business day, Tuesday. So if we're doing our counting again, May would have 17 days. Now again, why 17 is number 1, we count the 15th, and number 2, there are 31 days in May. There are 30 days in June, the summer month, July and August, which is good. Both have 31 days. September, you don't count the settlement date, so it's up to but not including the settlement date. Therefore, it would be 14 days in September, totaling 123 days. Again, the dollar value of accrued would be principal times the rate times the time, which is $85 multiplied by 123 divided by 360, which equals $28.64. So the buyer of this treasury would pay the market value, whatever it is, plus accrued interest of $28.64. Index options. For years, there's been stock options, the ability to speculate or hedge on individual securities. Well, in addition to that, there are index options where you can speculate and hedge on the movement of a specific group of securities, the overall market, in lieu of or in addition to buying and selling options on specific securities. So let's first do a chart that compares the two, because on the examination, you may be asked to compare equity options versus index options. So what is the underlying interest, as we talked about earlier, on an equity option? It's the individual stock. It's Apple, it's IBM, it's Twitter, it's Amazon, whatever the name of the stock is. 2, for index options, there is no actual individual stock. It's the value of an index, such as the S&P 500, the NASDAQ 100, the Dow Jones Industrial Average, the Russell 3000, some indice where there's a value assigned. Now, with equity options, the multiplier or the value per contract is 100 shares. 100 shares. That's easy. Each equity option is 100 shares of stock. Now, for index options, you can't deliver an index. You can't deliver and they don't want you delivering the shares of the index. Why don't you deliver 500 stocks in the S&P 500? So in order to make things easier, they came up with what's called a multiplier of 100. So for example, if the value of the index is 230, let's say 230, then the multiplier is 100, So the value of that index would be 230 times 100, or $23,000. If the index was, let's say, 400, it would be $40,000. So it's the value of the index multiplied times 100. Exercise. If you exercise an equity option, you either would receive or deliver the underlying stock. So if you bought a call option on Apple, that would be the right to receive 100 shares of Apple stock. For an index options, they are cash settled. So you don't deliver the actual securities, you deliver the cash difference between the closing index value and the strike price. So for example, if the strike price was 230 and the index value was 233, well, if we took those two numbers and each multiplied by 100, we'd have the following. 233 multiplied times 100 is $23,300. 230 times 100 is 23,000. So the cash difference between the closing index value, which is the close of business day, which is 233 or 23,300, and the strike price, again, our example 230, which is 23,000. The difference in those two numbers is $300. So if it was a call option, and since the market value or the value of the index is above the strike price, the writer of the index options would be required to deliver to the buyer the cash difference between the closing index value. Like, for example, in our example, it was $300. That's the difference. And lastly, which is unique, is the settlement date. Now, the settlement date here is tricky. It's not the settlement date on the option, because options settle the next business day. It's the settlement date on the underlying securities. So, for example, for a number of years, settlement date regular way was 3 business days following the trade day. Now it's 2 business days following the trade day. So be careful on the exam, because if you buy an option, the settlement date is the next business day. If you're asked, if you bought an option, a call option, and then you exercise that call option, when would the settlement date be on the securities transaction? Well, it's like buying the underlying stock. It'd be 2 business days from the date of the exercise. So sometimes on an examination, they might ask, when is the buyer of a call entitled to the dividend? Well, generally no, unless they exercise the call option prior to the X date, which means they're buying the stock prior to the Ex-Dividend date, which means they would be entitled to the dividend. Now, in addition to this, there are 2 main styles of index options. One is broad-based index options. That would be used for the S&P 500, the S&P 100, which it's not the number of stocks, because it could even be the Dow, which is only 30 stocks. It's what that index follows. Does it follow the entire market? So if you were looking to speculate on the entire market and you thought the market was going to go down, you could buy put options on a broad-based index option. If you were bullish, you would buy calls. If you thought there was going to be a lot of volatility, you'd go long a straddle on broad-based indices. What was also created is there's a lot of sectors. People like investing in bank stocks, in technology stocks, in stocks that follow media companies or oil and gas companies or pharmaceutical companies. So there are a number of what's called narrow-based index options. And again, it's not the number of stocks that's important. It's what those stocks follow. Do they follow one sector? So, for example, if you were a portfolio manager in the pharmaceutical industry, in other words, your portfolio consists of pharmaceutical stocks, then your main concern might be that the pharmaceutical market might have some bad news, or in general that sector might be hurt and the value of those securities could decline. What you may want to do to hedge is buy a put option on a pharmaceutical index. So if the market value of the stocks did fall, the index would fall. And if you bought the put, the premium on the put option would rise. Again, it's inversely related. And if you bought the put option and the market value of those stocks did decline and the premium of the put option rose, you could sell the put at a profit. The profit on the put option would help offset the loss you incurred or the depreciation in the value of the stocks because the overall market for those securities fell. So again, they can be used to speculate and hedge. They're broad-based that follow the entire market, and they're narrow-based that follow a sector. Although most equity options are not exercised, you could be asked on the examination, what would happen if an option was exercised? Now remember, equity options use what's called the American style of exercise, which means at any point prior to the expiration, the person owning the option is permitted to exercise the option. And if they own a call, they would buy the stock. If they own the put, they would sell the stock. Remember, options clearing transactions are done by the Options Clearing Corporation, not the trading. There are many different exchanges that trade options. The OCC, the Options Clearing Corp, does the settlement of the options and the exercise and the delivery of the actual securities. They're kind of the intermediary for that. So let's look at an example. What happens if our investor decides to exercise a call? So let's go through, starting on the bottom left-hand corner. A client is long 1 ABC February 60 call. The right to buy ABC is $60 a share. He or she decides they would like to exercise the option, so they notify their broker-dealer. Now, again, it could be 3 days before the exercise. In reality, most people won't do that, but the examination will focus on what would happen if they did. So the client notifies their broker-dealer they'd like to exercise the option. The client's broker-dealer then notifies the OCC. And remember, what the client simply wants is 100 shares of ABC at $60 a share. Someone who's on the other side of that trade, it could be thousands or hundreds of thousands of people that could have written an ABC February 60 call. So, how does the OCC determine which broker-dealer out of the hundreds possibly whose clients could have written that option, how do they determine which firm received an exercise notice? They will use a method known as random selection. So they will randomly select one broker-dealer whose clients have written that option. Obviously, the more your clients have written that option, the higher the probability your firm will receive an exercise notice. So, one of these firms receives an exercise notice. Let's say it's broker-dealer C. Now, broker-dealer C could have hundreds of thousands of clients that have each written that option. How does the broker-dealer determine how that happens? They assign a notice to a specific customer by using, one, random selection, which is most firms do use, because if it's good enough for the OCC, it's good enough for the firms. They can use first in, first out. It's another method. Or any other method that they deem and can actually justify as fair and reasonable. And again, one thing that could be tested is, what method must the OCC use? Answer, random selection. What method can the firm use? Any one that's fair and equitable, which could be FIFO or random selection. The other thing you got to remember is sometimes people ask you, well, how does a client know if they've written an option what method the firm will use? And it's disclosed to them. It's part of what's called the risk disclosure document and the options agreement. So in general, it would be discussed in the OCC risk disclosure document. And when the client signs the options agreement, it will be disclosed what methodology the firm will use to select. One last point is, we know that if you're long a February 60 call, you exercise the call, the exercise notice is going to a client or broker-dealer C. Well, what about the actual delivery of the security? Well, that's the last component, and that's the following. When you exercise the option, it settles in 2 business days from the date you exercise. So be careful. Again, the settlement date when you buy an option is the next business day. The settlement date on the option exercise is 2 business days from the day you exercise. Please remember, the settlement date is now 2 business days from the trade day, where it used to be 3 business days from the trade day. But effective September 2017, the settlement date on transactions in corporates and munis are 2 business days. When we discuss settlement dates, we said settlement dates was between the 2 broker-dealers. And settlement date is 2 business days from the trade date. Well, what rule is relevant for clients when they must pay for securities transactions? Well, payment date is regulated by the Federal Reserve Board Regulation T. So Reg T applies to the clients, where the settlement date T+2 applies to the broker-dealers. So let's go through this. According to the Federal Reserve Board, Reg T payment must be obtained for purchases in either a cash or a margin account within 2 business days of the settlement date. Well, if the settlement date is 2 business days, and you have 2 extra days to pay, that's settlement plus 2, or on the examination, T+4. Now, some people say, well, isn't Reg T for margin accounts? I said yes to some degree, mostly, but it also applies to when you have to pay. Here's the difference. If you buy a security in a cash account, you pay 100% of the value within 2 business days from the settlement date. If you buy it in a margin account, you're paying for it only, let's say, half of the amount of money, but you're paying the same time. The amount is different, but the date you pay is the same. Now, in addition to that, most broker-dealers say, well, if I have to pay in 2 business days, I want my client to pay in 2 business days. So although you have 2 extra business days to pay, many firms have stricter rules that require you to pay on the settlement date. So be careful. On the examination, you need to know that the payment date is no later than 2 business days from the settlement, or T+4, but in actual practice, the firm can have a stricter rule. Now, if the client has not paid by that date, T+4 or settlement plus 2, an extension, in other words, a lengthy amount of time, could be granted, but only by the firm's SRO, self-regulatory organization, which in most cases is FINRA. Now, in addition to that, if no payment is made by that date and no extension is granted, the position is closed out, the securities are sold at the opening the next business day, so that would be the 3rd business day from settlement or the 5th business day from the trade date. In other words, you bought something, didn't pay for it. If that happens, they'll do what's called the close out of the position. They'll sell out the securities in the account. Then you'll have what's called a frozen account. It doesn't mean your assets are frozen. It doesn't mean you can't withdraw money from the account, although it sounds like you can't, but you can. What a frozen account means is for the next 90 days, if you want to buy any security, not only do you have to pay for it in full, you have to pay for it in advance of the transaction. So the idea is they're not going to do a trade for you unless you put up the money first, which makes sense because you bought something originally and didn't pay for it. Now, if a client bought stock and then sold the stock and tried to use the proceeds from the sale to make the original payment, it sounds like it's too good to be true, which it is. In other words, if this was allowed, you'd be able to buy and sell without paying for anything. Well, that is not permitted. If you try to use the proceeds of a sale to meet the original margin call, it's a violation known as free riding. You're trying to take a free ride. Now, many clients get a little confused about this because they have like a money market account attached to their brokerage account. So they simply wire money in or transfer money in and then transfer money out, which you can do. The idea of the free riding concept is you have no money in the account, you buy something, it goes up in value, let's say, you then try to sell it, you do sell it, and you try to use the original proceeds. Technically, what you really have to do is buy the stock, put up the money, they'll sell out the securities, let's say at a profit, and then you're entitled to the profit because you've already paid for the securities. The SEC and most of the regulators were not thrilled with the fact that there were threshold securities. Remember, in order for the security to be a threshold security, there had to be a large number of fails for a good number of days. So, in order to reduce the number of threshold securities and naked short selling, in other words, selling short without doing a borrowing of the security, the SEC implemented something called Rule 204. The idea was, okay, how do we reduce the number of fails? We make people deliver securities. So what they said was, if you're a brokerage firm, you have basically 2 main choices. 1, deliver the security by settlement date. It's called following the rule. If the settlement date is 2 business days from the trade date, which it now is, used to be T+3, now it's T+2. So if the settlement date is 2 business days and you do a trade and you're the seller, deliver the security within 2 business days. Well, if you couldn't deliver the security within 2 business days, in other words, you said you were going to do something, you didn't do something, your other option was immediately purchase or borrow the security. If you, in other words, go in the market and buy it, or borrow it from another broker-dealer to close out the fail. In other words, you have a fail because you sold something, didn't deliver it. Since you have a fail in your book, either you buy the security or borrow the security no later than the beginning of regular trading in the morning hours on the next settlement date following the fail, which is the third business day. In other words, deliver by 2 days. If you can't deliver by 2 days, find a way to deliver by the third day by either borrowing it from someone, another broker-dealer, or client, or borrow it from someone, or go in the market the next morning to buy the security to deliver it to the client who bought it from you. Therefore, you would not have a fail. Well, like any good rule, there are some exceptions, and there are two main exceptions. One, a similar exception to long sales, which we discussed, is 35 days for transactions in which the client is long but cannot deliver because of a Rule 144 transaction. In other words, a client owns restricted stock, sells a security. It may take us, and again, the client is long the securities, and because it takes some time to get the restriction off. You have to get a letter from counsel. You have to transfer the securities from the restricted position with the client's name on it to street name. It takes a while, but it can't take longer than 35 days. So one exception is no more than 35 days for transaction which the client's long but cannot deliver due to some other circumstances, usually the restricted stock, and it's a 144 transaction. Now, when 204 was written, certain brokerage firms complained, except for market makers. Market makers say, well, if I'm selling a security, it may be because a client wants to purchase securities, let's say 100,000 shares, and I only have 80,000. So I'm going to sell all 100, even though I don't have 20 of them, because I want to facilitate market making and facilitate liquidity. Well, the regulators say, okay, but you should be able to deliver the securities within 2 business days. Well, the compromise was this. The SEC gave market makers and long sales, in other words, sales which the client actually owns the securities, 2 extra days from the settlement date to deliver. And if not, that position has to be closed out the morning of the next day. So, for example, you do a trade, it's supposed to settle in 2 business days. You're the seller, so you're supposed to deliver the stock within 2 business days. But if you're a market maker or a long sale, you get 2 extra days from that settlement date, which is 4 business days from the trade date. However, if you have not effected delivery within 4 business days from the trade date, the first 2 settlement days plus the next 2 settlement days, 2 extra days, you got to go in the market and do a buy-in, similar to what we talked about earlier, to close out your fail the morning of the 5th day, the 5th business day from the trade date. STC would like to thank you for purchasing our product, whatever licensing exam you are taking. We wish you the best of luck in your examination. If you have any questions or concern, please contact us at stcusa.com. On the website, stcusa.com, there will be some course update information regarding T+2 settlement date, which you can print out. And again, there are examination questions, our content, our flashcards will all be changed relatively soon. But in the meantime, you have this presentation to view to get further information on T+2 and how it may affect your licensing examination. Again, good luck on the examination.